I'm market analyst Michael Filighera of Traders Helping Traders with the Eye of the Storm podcast, helping you make informed trading decisions for the week ahead. And good day, everybody. Here we are again, Dan Ascani and myself, and welcome to the Eye of the Storm podcast for Saturday, February the 4th, 2023. Dan is again my guest, and the intent today is that we will be talking about what I considered part two of our discussion on tapping the power of gold to build your wealth, to defend your wealth, many, many different things. Dan will be going into more detail on that today. So that's going to be a very great conversation. But first, Dan and I were talking yesterday. Dan and I were talking again this morning, or actually this afternoon. Just trying to take a look at what happened yesterday. And so we feel that it's worthy of our joint conversation. And we've already started it. So we're going to try to put in some reviews of what we thought and what we saw and how that all panned out for the balance of the day yesterday. And maybe also what that will also include in moving forward. As you both already, oh, not you both, that's us. As you know and understand already that Dan was my first teacher in Elliott Wave. So I still consider Dan a master of Elliott Wave and Fibonacci. And so he continues to analyze the markets in that manner, use his own analysis to build his own trades, and just so that we can forecast what we perceive and what we see may be happening in the future. I continue to use Elliott Wave. And as you all know, that I have my weekly update, which will be coming up later today, or again, maybe tomorrow morning. And that will just be on the big picture review. And so let's get started. And thank you again for joining me today, Dan. I really appreciate it.
And thank you for having me again, Michael. I'm enjoying it.
We both are. And now we hope that everybody else is going to see this synergy that we have built up over our last 30 plus years of being analysts together and publishing together and then just enjoying each other's company. Let's start with Friday. And let's start with what basically started it. I mean, coming into Friday, the thought process was, and I know you and I talked about this, is that the S&P, for certain, I had left open the potential and the probability that the S&P was going to try to close itself up at 4,200. And so, and that pretty much even was a given from the market when we took a look at some of like the options in the SPX, the options in the ES, what they were looking for in the morning expiration, and then for also the afternoon expirations. And it seemed to all fall into line. Then we also had heard from our illustrious Federal Reserve and the chairman on Wednesday, basically giving us, as expected, only a 25 basis point hike in the interest rate, in the Fed funds rate, and then giving what I thought was a written statement that presented itself as more hawkish versus a press conference. And I hate to say it, but I am going to say it. I thought it was Hiram Milquetoast and that it was so dovish rather than hawkish. And I'm like, well, who are you pandering to here, Mr. Powell? And consequently, what had ended up happening is that our markets rallied very, very strongly on Wednesday. And then again, they had more of the whole session on Thursday to put in some very stellar upside. In fact, on Thursday, the S&P reached a target level that I had been calling for quite some time for this, which I can right now still consider to be an intermediate wave 2. That may have completed right at that 420809 level, which presented a cluster of Fibonacci resistance in my work. And so it made total sense that it stopped there and immediately just reversed. It was rejected, immediately reversed. Then we come into Friday morning, and the first thing that's going to be released is the employment situation numbers, and that's the latest data. I did read what the consensus was So what the market was looking for, and the consensus was for like 256,000. And it came out closer to 500,000. I think actually one number was a little bit above 500,000. That, even to me, folks, that was like a massive surprise. And only thing I could really think of is that it was Jerome Powell's worst nightmare. After giving this, well, the employment market, the jobs market is very robust, to like, holy crap, it's way more robust than I ever thought. Because as I know, and Dan knows, and we've discussed, it is a wonderful thing for people to be finding work and getting good jobs and having the ability to pay the mortgage and or rent and utilities and buying food and raising a family. There is nothing wrong with that. In fact, it warms my heart to see more people working than not working. But we're in an inflationary period right now. And so where I'm going to start our discussion is that, yes, those numbers presented a very strong word against what the Fed is doing in terms of trying to lighten up the load on how much they're going to raise, because it was such a gigantic surprise. Now, first reaction out of the box for the market was to drop the market 300-400 points. Then we saw the opening. So this is where I'm going to start a conversation as to why we think what happened in the market. And one thing that I mentioned to people that subscribe to me on YouTube and then also within my trade room is that we always have to be aware of all of the orders that come in overnight. And they get all sorted out and put into the algorithmic functions that are going to put those orders into the marketplace. And so all the buys get stacked and timed, and the sells are stacked and timed, and then push the button and off it goes. And so we're all looking for, okay, everyone, the market's going to open. It should just start to sink and sink and sink and sink. And it didn't. It went up, it went up, it went up, it went up, and it just kept going. Now, the one thing I noticed is that it truly was basically, again, since my major market that I trade is the NASDAQ, it was Apple, Metaverse, Microsoft, Tesla. Four stocks, a couple others got added by the end of the day. Four stocks controlling an up move. Now, I'm going to kind of like, you had mentioned some really interesting things in terms about the options. So those are my thoughts. I mean, I think that truly it went totally against what I think the majority of traders, professional and non, were expecting should be coming through. And then to see that at some point it was totally 100% rejected again, several times during the day. So what did you think? What were your observations of what was going on Friday morning?
Well, I had my seatbelt on, I'll tell you, and it's a good thing because it was wild. So we had the FOMC, the Federal Open Market Committee meeting on Wednesday, and the Jerome Powell press conference raised rates 25 basis points as expected. And there are a few things that happened after that. Then you come to Friday, like you're talking about, the non-farm payrolls report or the employment situation report. They keep changing what they call it, but whatever. Yeah. And I mean, we had a situation where bonds were down heavily.
Yes.
Commodities like gold were down heavily. So with bonds down, rates were rising a lot. And gold was down, and commodities were down. And then you had the dollar soaring. I think the dollar index was up 100 basis points, 1 full point on Friday. And so you come in and you see the S&P, and coming off of Thursday post FOMC, you had a lot of people unwinding really bearish positions. So the thinking was, the talk on the street was, for the FOMC meeting ending on Wednesday, a lot of people had put on bearish bets because they felt Jerome Powell was once again going to get up to the microphone and start saying, look, I'm going to remain hawkish. I'm going to keep raising rates. I'm, whether you guys believe me or not, and the market's been a little disbelieving of the Fed, stance, but whether you guys believe me or not, I'm going to keep raising rates. So when he came in and he wasn't quite as hawkish about the market, people thought he was going to try to pound the market down or jawbone the market down by saying, everyone knows that the rising market kind of defeats what Powell is and the Fed are trying to do. So when he didn't do that, we saw some short covering and some buying on Thursday. Then non-farm payrolls came in, the employment situation on Friday, plus 507,000 with an unemployment rate at the lowest since sometime in the 60s. I think it was 1969, right? Incredible numbers. Everyone thought the market would be down big time, but I think there was still some short covering. You mentioned that we were talking about the option structure.
Right.
If you look at the open interest in options, and this is important whether you trade options or not, because the options volume starting a couple of years ago, I don't know the exact date, a couple of years ago, and then continuing into last year and this year, has been many times exceeding the volume of all the stocks traded on the stock exchange. So what that does is it causes the dealers to have to manage their hedge books in a pretty big way. So they're influencing the market. You've got macro traders, investors and institutions analyzing the macro picture, interest rates and economic growth and so forth. You've got them in there. So the option structure seemed to point to a 4,200 possible pin in the S&P 500.
Right.
Meaning that's where the most open interest in options are. So the market tends to sometimes on option expiration day, like Friday, gravitate towards that.
Right.
And it did a couple of times. I mean, it touched there Thursday, it touched there Friday, and then sold off. And I think what was happening partly was a lot of that short covering got unwound Thursday and Friday. And people had to really think, do I want to hold long positions over the weekend with this kind of a strong employment report? Because that just simply means that the Fed is probably going to keep rates firm for maybe longer than we had hoped. The market's been a little bit unwilling to believe that the Fed's going to keep rates up for a long time. The market's looking for the narrative anyway. If you talk to a lot of people or look at the financial media, the narrative you hear is that people are looking for a situation where the Fed's going to pivot and they're going to cause a recession, and the Fed's going to start lowering rates sooner than the Fed's ready. So I think the market, which I hate to ever say the market's wrong, because whenever I say that, the market tends to be right. But, you got to look at the way the market is and what the structure is. So it really was a situation where people had to think all day long, it seemed like. Yeah. And you saw all these positions being wound and unwound. And to top it off, like you and I were talking before we came on to record this podcast, you and I were talking about how there's a change in the situation, even intraday Friday. So interest rates were, I want to say, soaring. They were up sharply. The dollar was up sharply. Gold and other commodities were down sharply. And so it's almost changing the metrics for the institutions during the day Friday. And so the market actually attracted some selling coming into the 4,200 area. And I think it kind of whittled away at that option structure. So by the end of the day, it closed well off that level. Right. And next week, I'm telling you, it's going to be interesting.
It's going to be very interesting. It is going to, I agree with you. It's going to be very interesting. One thing that you mentioned, if you wouldn't mind, if it's allowable, you had mentioned, you talked about the call wall. Can you make a little reference on, because that, when you brought that to my attention on Friday, I was already looking at the options in the big tech stocks, which I know were controlling, at least in the NASDAQ, they were controlling the narrative and they were controlling the market at the time. And that overflowed then to the S&P. And not to tangent, but one of the things that I believe the S&P, the governing board of the Standard & Poor's, when they put together this index and then they put together the weighting, I know that it's a cap weighted index, but boy, I think that they're going to be sorry that at times that actually is occurring, because what it does is it puts the heaviest stocks, the heaviest weighted stocks, up at the top, and they just happen to be Apple, Tesla, Amazon, Google, all of these stocks that were massively affected by, first of all, Apple, Google, and Amazon, the trifecta, came out on Thursday. They all basically disappointed. They all finished lower after earnings. So, in that extra hour or so, and then as Globex reopened, they continued to move lower and held lower. Apple comes in on Friday morning, and I see that it's like it had closed not super below 150, but I saw that the open interest was the highest in the 150 call that expired on Friday. Then I noticed that the volatility in Apple coming in on Friday was the highest I'd seen it for an expiration in the last several months. So I'm like, okay, something's up. They're going to go for this 150, folks. But not only did they go for the 150, they went for 152.5, and then they went for 155. Now, my thing is, it's like, for people to truly understand that when a market does that, when it goes shooting through these strike prices, that it forces large institutions, large players, they have no choice. They must come in and adjust. If they have that options position and they're going to continue to hold it, they're going to have to adjust their position. Various reasons. One I talked about is like, if they're putting it on delta neutral versus fully hedged, then, they're going to get stuck even harder, because the delta is going to go closer to 100 the closer it gets to that strike or above that strike. Now, so we've got that going on. But then I watched in Tesla and also in Meta. Meta, they got the stock buyback, and that stock just took off after their earnings on Wednesday and then on Thursday, and then coming in on Friday, they were beelining for $200. Both Metaverse and Tesla shooting for $200. Tesla got the closest by hitting 199. So, but the one thing I did notice, and then you confirmed it with that call wall statement that you gave to me on Friday, that when I was looking at the option pages, I was like, nobody's trading puts. Nobody's trading puts. They're all in the calls. So I'm going to turn it back over to you. What was that telling you?
Well, first, to describe what the call wall is, actually, that's a term coined by Brent Kachuba at Spot Gamma. Does some great work over there. But the call wall, if you keep track of, or if you look at open interest in the various option strikes, let's say the S&P or the SPX or the SPY and the NASDAQ, same thing. But let's take the SPX. If you look at open interest in the various strikes on a certain expiration, in this case, Friday, then you can see a predominance of open interest at a particular strike. In this case, a lot of open interest at 4,200. It's been building there. Actually, it shifted up during the week. When it shifts up, that means it's pretty much bullish. The market has accepted pricing earlier in the week, and it's going to try to go higher, and it did Thursday and Friday. So not to get too esoteric here, but it's a little bit important. If you think about why options are important, even if you don't trade them because of the volume, if you think about a person hedging their portfolio by buying puts or selling calls, like covered calls against their stock positions, if you sell a call, then the dealer making the market in that call is going to have to buy it, right? So you sell a call against your stock or your S&P, whatever your portfolio, dealer has to buy it. So the dealer is now long the market, and the dealers aren't going to speculate in the direction for the most part. So they're going to go right back in and hedge with the underlying or with futures. So they're long the market because they had to buy a call that you sold, and then they might sell the underlying or sell the futures to balance it. So then you come into Friday with all this volatility. In fact, every day there's a lot of volatility now, but so there's a lot of hedge book management. So if you're looking at the call wall with the most open interest at 4,200, And then you got the market selling off the initial non-farm payrolls release because the economy was so robust that there was a lot of payroll created that implies the Fed is going to have to raise rates and keep them up longer, et cetera. And the market sold off. But on the other hand, it also implies that maybe might see a soft landing. I'm not predicting this or anything with this respect to the statement, but the thinking was, can the Fed engineer this battle against inflation and not tank the economy into a hard recession? Can there be a soft landing, which would be nirvana for the market, for equities, and for everything, really? So robust job creation last month, seasonal adjustments notwithstanding, and the 4,200 call wall and dealers having to manage their hedge book. And then you got other people coming in, macro traders, we can call them. Those are investors, institutional or retail, who are analyzing interest rates and earnings and, the macroeconomic stuff. And they're making their decisions, and you get a lot of volatility. So when the market sold off initially after the non-farm payrolls number was so high, above 500,000, some buying came in for various reasons. First of all, the call wall was up there. So the tendency for the market is to gravitate toward that call wall on expiration if it's already in an uptrend. Vice versa for the put wall down to the downside, but that's not happening right now. The market was very strong.
Right.
So my reference that I gave you on Friday was the call wall had shifted up this week. It's probably going to try to gravitate towards that level, maybe even pin there. Sometimes the market will pin right at that call wall. You'll see it close at 4,200 plus or minus whatever.
Right.
In this case, that didn't happen. There's other reasons for that, but that's basically what I was referring to and what happened. We have an economy that's very difficult to interpret. I think Larry Summers was even quoted in some of the media saying that same thing. This is a very difficult economy to interpret. Like, can the Fed engineer a soft landing? Will it cause a recession? Will we have to keep rates up? So that's a fairly long-winded answer to what you were asking, and that's what we ended up doing Friday. Lots of activity, lots of interesting trading to come.
I agree. But you just brought up another question that I have. Since we are both Elliott Wave analysts, and we're now talking about the S&P, and we're talking about can the economy or can the market, along with the Fed, really engineer a soft landing, which would be great for the United States, for the global economies. Just like, okay, we're going to take care of this. We're just going to kind of come in, do a nice soft, instead of hard bounce, come in and we'll go, and then we'll take off. Touch and go type, we'll call it, right? And to have a success. Now, my personal count, is that the market is finishing up an intermediate wave 2 within a primary C wave down. So if I'm really looking for a soft landing, we may still get it, but I think where it may come is that once primary C is done, it's going to finish cycle wave A down. Then we get a cycle B wave. So this whole concept of a soft landing may still take hold, and actually may still happen. But as you're saying that, it's like we get into it, it's like, okay, how hard of a recession we go into? How hard of a deflationary period will we go into? So that's why I think it's like even question like what Larry Summers is saying, is like, yeah, we are in a very difficult position because you can't really say with strong conviction, oh, watch out, we're going to go. But if I put it to what I'm seeing in terms of the Elliott count that I have, and then also comparing that to what I know to be the characteristics and the personalities of those types of waves, and then times it by the degree size that I see coming, I think we might get our soft landing, and it's going to be followed by a deeper recession, or even worse, or a period of deflation. I hate to say this, but I'm going to say it, that could make 2009 look like kids play.
Interesting you should say that, because what we don't want to lose sight of is how the 2008, 2009 collapse signified a broken financial system, and it's still broken if you think about it.
Yes, it is.
They put it in intensive care unit, gave it an oxygen mask, bandaged it back together. The Fed went into rescue mode to rescue the banking system, but also it kept pumping money into the system, as you know, for years through quantitative easing by keeping interest rates at zero for a long period of time, years, and by buying treasury bonds and mortgage-backed securities, et cetera,
Right.
to support them, actually actively manipulating the interest rate market and openly doing so without hiding it, which is another subject right there. We can do a whole podcast on that.
If we can.
We can't lose the sight that the system broke,
Yeah.
not just in the US, but globally. They try to patch it together. We've gotten to this point, but look how incredibly dependent the stock market is on every word every Fed governor says, every Federal Open Market Committee meeting on interest rates, every decision.
Right.
It's like, please give us, I called it a baba. It's like a baby needing a bottle. The market needs its baba. Fed injection of liquidity to keep going, because look what happened when they pulled liquidity last year and started raising rates. The market dropped. S&P down 20% at some point, NASDAQ down 33%. Now, the liquidity came out of the market, and that the market ended with a drop, and now it's hoping for more liquidity. But if you think about it, if we're so dependent on the Fed, if the market's so dependent on the Fed to pump liquidity back in, then we're really walking a fine line here, because if you look at earnings and you look at the big three on Thursday, like you mentioned, Apple, Google, and Amazon missing, and their guidance implying that, there may be some rough waters ahead, or it may be difficult to navigate anyway. So we're in a situation where we're not relying on conventional macroeconomics, traditional macroeconomics, earnings, interest rates, and all that equation. That the market wants more Fed liquidity. And that's part of the problem here, because that whole, I'm going to call it a bubble, into the top in 2022, January 2022, the first trading day of the year. It bubbled up like it did in 1999, 2000, the tech bubble. Same type of thing. We're following a very similar scenario. So you get a drop in 2022 of at one point 20% in the S&P, 33% in the NASDAQ. Now you're getting a rebound. That's very typical. Very typical. We got a big rebound in 2001, early 2002, after 9/11, and after that initial drop off, the bubble burst, the tech bubble burst then.
Right.
5-month rally, I think it was, into the spring of 2002, and then we dumped again.
Right.
The whole process, the NASDAQ lost something like 75 to 90% of its value, depending on whether you look at the NASDAQ 100, the closing basis, or the intraday basis on all that. So it's very, I'm not one that believes the Fed can fine tune this so much to engineer a soft landing, avoid a hard landing. In fact, I wish they wouldn't meddle so much in the markets, because we lost whatever semblance of a free market we had. It's manipulated by the very Fed and through government stimulus and so forth, but at least by the Fed more than ever since the crash of 08, 09. And then the COVID crash, it's just manipulated. And I kind of wish they would just let the market find its own footing. And I think that's part of what happened Thursday after the FOMC meeting. There were a lot of people putting on bearish bets that the Fed would be hawkish and that Powell would come out in the press conference Wednesday complaining about, not that he would do that in a complaint form, but complaining that the market is erasing part of his easing by rallying and hoping that the Fed's going to stop easing, or at least tone down his interest rate increases sooner rather than later. But he didn't do that. So that left open more rally in the market. And I think that's what we saw into Friday's post non-farm payrolls rally. And it's going to be interesting, like we've been saying, or like I've been saying, it's going to be interesting going forward, because you've got earnings misses, you've got a hawkish Fed, you've got inflation that may have come down a little bit. It's still there. It's not cured. It's not out of the system. It's embedded in the economy. It's going to be tough to get rid of that, especially when you see employment numbers like Friday which means you could get wage push inflation. You could get wages helping push up prices even more. It's kind of a mess if you think about it.
It is a mess. I have to agree with you. But I'm going to kind of wrap up this part of our conversation because I want to leave enough time because we do want to talk about gold. But in encapsulating what we're talking about and maybe looking forward to what we can add to this in the coming weeks would be, I really want to bring in our Elliott counts because they fit so cleanly and they really tell the story. And when we can combine the reality of what we're seeing happening to the Elliott count, I think it might give people a little bit better understanding of when I may be saying, look, I'm still looking for a low, and that would be on the cycle degree A. And then what comes next is a kick your butt straight up rally, but it's a B wave. And they give us that opportunity to share with everybody else all the wonderful things you and Robert Prechter taught me 30-some years ago about this is what a B wave looks like. This is what's inside of it. This is what's behind it, et cetera, et cetera. Because I think that's going to help when we're in this, if we're in a, there's a possibility on the primary degree level that we're still within that primary B up, the recovery. And believe it or not, as we all know, if we take a look at 2008, 2009, the Dow all by itself decided to go irregular B, go up and create a new high, new all-time high at the time. And everybody, I can remember because I was there, everybody kind of looked at themselves, what is going on in the Dow? Why are they feeling they're the only ones that really should go up? The S&P got close but didn't do it. But then, as I've been telling people now, it's like, you know, folks, if you're really considering and thinking that we're going to new highs, that may be, and you can trade it on a purely technical basis. But the last time this happened, please go back and reference 2008, 2009, so you will see what the result of that is. And reaches a new high on high optimism and everything looks pretty and wonderful. And we collapsed and the economy collapsed. And we went through a very strong period of deflation that even surprised me. And it surprised me in the way of what I saw traders doing. For example, there was one day that I'm sitting and I'm watching Ford, which is a massive corporation. It's a huge corporation who's got inventory all across the world, who's you know, and they were trading it down to $1.50. And I'm like, if they closed the doors and decided we're going to sell everything off, it's got to be worth more than $1.50. Simply because of the inventory that they have, of the things that they have, which are tangible. And all I can say is like, that's coming again. I think what people need to understand as well is like, you have a period of inflation and then you have a period of deflation. The soft landing, folks, is that they're going to try to control that deflation. They're going to try to make it easy so that it comes down, skids, and then starts to go back up again. Because the only way out of this is not for the Fed necessarily to reinflate like they did in 2009, like they did after COVID, et cetera, et cetera. It's got to be that we, as the population, you know, start putting our money back out there, start putting our money into these things, and we reinflate along with corporations. So many interesting conversations that I think yet to come, and hopefully we'll be able to add our Elliott to it, because I know a lot of people are coming in and, you know, because they're coming into eye of the storm, because that's what I do. I talk Elliott. So I think we'll do that. But let's tangent over, because the other thing we try to do is to try to keep our conversations to a reasonable amount of time, folks. And so we're going to try to do that today. But we want to continue our conversation on tapping into the power of gold to build and defend your wealth, basically, is the whole title. And last week we discussed gold in a deflationary economy. And I want to thank everybody that did come in and watch it. And thank you very much for the comments. They were very encouraging. So in that note, I'm going to turn it back over to you, Dan, and we're just going to pick up basically where the conversation was. Excuse me. And you had already discussed like where we're going to head. So I'm just going to let you go ahead and lead this conversation into what we want to talk about today in tapping into the power of gold.
Right, to elaborate on what you said, and we covered this in part one of the Eye of the Storm podcast, was in 1997, I published the report called Gold in a Deflationary Economy. It was our best-selling report ever. And the reason I published that was because I see a huge misunderstanding on the part of almost everyone, and not everyone, but retail, institution, analysts coming across the financial media on gold.
Right.
Most people dismiss gold and say, oh, it's a safe haven asset. So if times are bad, you buy gold, or it's an inflation hedge. And I'm not saying it's not, but that's not how you understand gold. And so what I felt was going to happen in the 90s is when the tech bubble burst, and it was only 3 more years later that it did burst, we're going to have deflation to deal with. And so I called it gold in a deflationary economy, and I got a hold of almost 500 years of data from Professor Roy Jastrom at the University of California, Berkeley, who wrote a book called The Golden Constant. It's long out of print. I was very lucky to get one 30 years ago, to get a copy of it. And I'm very lucky he published his methodology in there, because I was able to continue his methodology and continue the forecast and continue to pass on the message of how gold really acts, busting those myths of what people generally dismiss gold as being. So I updated the report in 2009. I called it Tapping the Power of Gold to Defend and Build Your Wealth. I'm now doing the third update to that in the last, I guess it's 25 years. And it'll be called Tapping the Power of Gold to Defend and Build Your Wealth, because that's really what it is. And so I don't want to make this too long-winded, but that was just a recap of where we came into this podcast today. And also I would say that to understand gold, you really have to understand what it is. Most people want to say, well, it's an investment for hard times or an inflation hedge, so I want to buy it at whatever, $1,500 an ounce, and it goes to 2,000, I made $500 an ounce. But it's more than that. Gold is a long time store of value. If you don't believe that, just ask any central bank. And I can go into that in more detail. The central banks hold gold. In fact, they accumulated in 2022 at the highest clip, the fastest clip since 1967. Central banks are accumulating gold, and they put it to work. Central banks get a yield on gold. It works for them. Mints that mint gold coins and silver coins and whatever else get a yield off their gold holdings. Right. And it's an intricate market that does that. But if it behooves the investor or the consumer or anyone to not just dismiss gold as a safe haven or something you buy when things are tough or an inflation hedge, because it's actually a better deflation hedge than an inflation hedge, even though it's both. Why is that? Because gold really acts more like a currency than a commodity. It's classified as a commodity.
Right.
But if you think about it, it's a currency. And why is that? Because we exchange currency for gold. We whether we live in the United States and exchange dollars for gold, or we live in Europe and exchange euros for gold, or Japan, yen for gold, etc. It's a currency, really.
Right.
So the reason it's a currency is because monetary policy of all the countries, I'm going to say all of them, debase their paper currencies. Because what's the dollar? What's the euro? What's the yen? It's a piece of paper.
It's worthless.
But by government fiat is worth something.
Right.
And that fiat is important because that's how we settle our debts and pay our bills.
Right.
But if you look at the value of the dollar in terms of what it can buy, how many dollars do I have to spend on a basket of commodities?
Right.
Versus how many ounces of gold do I have to spend on the same basket? And you'll see over time that gold is a store of value. And for other reasons, it does yield a return. And I said, ask any central banker. We can cover that as we go through this podcast if we have time. But if you think of it more of a currency, more of a hedge against the debasement of paper currency,
right,
the loss of purchasing power is what debasement is. just look in your wallet and find out how many more dollars you have to pull out to buy a gallon of gasoline, or to go to the store and buy that basket of goods or food anyway, or any goods and services. Everyone knows, everyone feels the sting of inflation.
Mm-hmm.
But if you take an ounce of gold, it holds its store of value. So in the report, Tapping the Power of Gold to Defend and Build Your Wealth, that I'm updating, in each edition, I've used an example of how many ounces of gold does it take to buy, excuse me, let me rephrase that. How many gallons of gas does an ounce of gold buy? And how many dollars does it take to buy that same amount of gas? So when I wrote the report in 1997, I think gas was 86 cents a gallon, or $1 a gallon, if you can imagine that.
I can't.
And gold was around 285 to 300, it was fluctuating in that area back then. So if you just, I'm going to round out some numbers here to not do it complex arithmetic in my head here, but if you, in 1997, if you would have said an ounce of gold buys, let's just round it off and say 300 gallons of gas at $1 a gallon at 300 an ounce gold.
Right.
I have to dig out $300 to buy that amount of gas. Fast forward to now, gold's at $1,800, $1,900 an ounce. Gasoline's, depending on where you live, at $4, $5, $6, $7 a gallon, depending where you are and what grade you buy, but using unleaded as an example. Now, how many dollars do you have to pull out of your wallet to buy that same amount of gas? 300 gallons of gas? But it's the same ounce of gold. In fact, I think gold buys even a few more gallons now.
Say buys even more, yeah,
than 25 years ago.
Right.
That's really how you should view gold in terms of the service it does to preserving your wealth. And the reason I say tapping the power of gold to defend and build your wealth is because Professor Roy Daström advanced this concept, and I love it. It's called operational wealth. Your wealth is really a function of how much does my wealth buy in terms of goods and services, because that's what we're here to do. We're here to live. We have to buy food, gas, heating, discretionary income. We want to have streaming services, whatever it is. So how much of that basket of goods and services does an ounce of gold buy versus how many dollars do you have to pull out of your wallet to do that? Everyone knows over time you have to pull more and more and more dollars out of your wallet. And gold fluctuates. So I'm not saying that every single day it buys the same number of gallons of gas or the same basket of goods or food, whatever.
Right.
Gold as a commodity is volatile, and you got to be careful what you do. You can't run out and just buy a bunch of gold. There is risk. But on the other hand, if you think of it in terms of operational wealth, in terms of the return you can get off of gold, ask any central banker, then and think of gold as a currency instead of a commodity, then you can understand a little bit more of how it might function in your portfolio and in your life as a consumer in terms of what it can buy.
Very good point. And I kind of want to go into that, because what I thought you also brought out in the report is people's concept of what their worth is, what their monetary worth is versus operational. So you have those two views. And when people are like saying, well, I'm worth X because my house is worth this amount. I have this much in the bank. I have this here, my car, my this, my that. And so that's how they determine what they feel their value or their worth is. And as we know, that's fleeting, that's subject to the move of the currency, whether we're inflationary or deflationary, et cetera, et cetera. But you made a very solid point, and you've just demonstrated again how when you hear someone like myself or you say gold is a storehouse of value that will and should remain constant no matter what is actually going on in the currency of which it's being traded. And you've just kind of said, but you also brought out into that report, which I thought also was actually good, was silver. Not that it is the little brother or little sister to gold, gold being the daddy of it, simply because of how it gets priced versus silver. But silver also can be a storehouse of value. And if we truly do go into a solid deflationary period, what you have in terms of silver, like coin or just, bars, you are protecting your wealth. And when you have it in gold, you are protecting your wealth. But what I'd like you to kind of head into now is, let's dispel this concept that gold doesn't give you any interest. Gold as an investment, what do you get? Doesn't pay a dividend, doesn't pay anything. And I know you've already dispelled this. I'm well aware of it. We trade it. But now just to share, kind of maybe broad-based, but just kind of maybe get into that a little bit for us.
All right, so to give an example, and I mentioned ask any central banker or any hedge fund or anyone dealing in gold in the cash market in quantity, but let's take the central banks. Central banks have tons of gold literally in their possession as reserves, gold reserves. They don't just let it sit there. They can actually get what's called the deposit rate on gold. So you can actually, a central bank, for example, can take a certain amount of gold and arrange a swap agreement with a bullion bank and say, here's a set amount of gold, give me some dollars. And we agree in a certain amount of time that we'll agree on, let's say in 6 months, we're going to swap that back. So I just want to give you this gold for 6 months, and you're going to give me, the bullion bank's going to give me dollars in exchange. I'm going to pay you the deposit rate for that. And then I, as a central bank, I'm going to take those dollars and invest them at some secure rate. For example, it's been LIBOR for years, but there's been problems with LIBOR manipulating the rate, and now they're coming out with a new system. But let's just say LIBOR. So that central bank can then invest it at LIBOR, and if that
and tell us again, we know, but LIBOR stands for
London Interbank Offered Rate. So that's the bank that, that's the interest rate that banks pay each other or whoever for that type of a situation. It's also what mortgages and variable rate interest, variable rate mortgages and other loans have been tied to. So what LIBOR is, what the London Interbank Offered Rate is, at a certain margin, and that may be what people's variable rate mortgages or whatever are, what they're going for. So the point is, if that LIBOR rate is higher than what a central bank pays that bullion bank to take this gold in this swap arrangement and give me dollars to invest, then they're making that spread. They're actually getting a return. And it's not just central banks that do that, it's hedge funds. I ran a hedge fund that did the same strategy in the cash market through gold forwards. Those are cash gold forward markets, like, for example, a jeweler would use, or a gold miner would use. A gold miner, for example, maybe hasn't pulled this particular amount of gold out of the ground yet and is worried the prices are going to decline, gold prices are going to decline, so they forward sell the contract. And on the opposite end of that might be a jeweler who's saying, for Christmas, I'm going to need a certain amount of gold to make jewelry that people are going to buy. So I'm going to buy gold and lock in the price now. I'm going to buy a gold forward contract that by November, I'm just using this as an example, I'm taking delivery on gold off that contract. So the point is, these transactions exist in the cash market, the over-the-counter market, in the bullion industry, and that's how you get a yield off of it. So a central banker or a hedge fund or somebody could actually sell gold forward and achieve that difference in the rate between LIBOR and the deposit rate. And it gets complicated. I'm probably getting already too complicated here. It's pretty esoteric, but suffice it to say that gold does yield a return. It is put to work by central banks, hedge funds, mints.
Yeah.
mints who mint gold coins and by producers. It's a big market. It always has been, at least since we dropped the gold standard in the 70s.
Right.
And so it does yield a return. And so it doesn't, I think it behooves investors to not dismiss gold as something that never yields anything, and not and to not think that it's just an inflation hedge or a, some sort of something to buy when times are bad. And in the report, the original Gold and Deflationary Economy report and the Tapping the Power to Defend Your and Build Your Wealth reports, the third edition of which I'm updating now, I go over periods from that almost 500 years of commodity data that I have, that I was able to get off Professor Roy Jastrom, and since he passed on in the 70s, update for the next 40, 50 years. I've been able to take that and continue it.
Right.
And it still works. There's still this function that gold has that can defend and build your wealth. It can also defend against currency debasement, which we all know is going on across the world with paper currency
every day,
constantly.
Every day.
And the Fed's battling it, and central banks across the world are battling it in a big way right now. Inflation is embedded in the economies, and it's something to deal with. So the Fed, the central bank, and other foreign central banks have to employ deflationary monetary strategies like quantitative tightening and raising interest rates, things that deflate the monetary base, which, by the way, the money supply declined for the first time in many years last year.
Good point.
They're deflating the monetary base. They have to overcompensate for the inflation that's been caused by the same process. The Fed, not to blame only the Fed, but Congress's incredible trillions of dollars worth of fiscal stimulus from the COVID lockdown period and after the crash of 2008, several periods of massive $1 trillion stimulus that eventually has to go somewhere. And unfortunately, it's embedded itself in our economies.
Right.
It's causing inflation. And now you've got the Fed trying to compensate.
Agreed. And I think the last round of stimulus that we're now seeing as we get these non-farm and the employment situation report that we got on Friday, we cannot forget that at the beginning of the year, they finally did put through and got $1.8 trillion stimulus that got shoved back into the system. A great part of that, not all of it, folks, because I've already gotten comments, people tell me it wasn't all of it, and I know it wasn't. But a great portion of it, I think upwards of $800 billion, was put towards the infrastructure package, which puts a great number of people back to work and in good jobs that have benefits. So everything that we look for, and how do we build up our economy? How do we keep our country functioning and improve itself altogether? Well, part of it is that is that infrastructure package. Now, people may disagree with it. People may talk about this and that, but bottom line is the act itself, in my mind, is bullish. How it just got stimulated to get going and the period of time in which it's happening at the top end of a very strong inflationary period, based on all of this money being injected back into the monetary systems, not only in our country, but we know that there were many European countries that had no choice, but they also had to stimulate. They also had to have put money in because people were suffering as great as they were and continue are. So put that into the whole thing. And what I kind of want to tie it into, I wanted to add that to the conversation, to the points that you were making. But now I think one more important part that is how gold can work for you. Gold will give you a return. Even if you're holding it as a storehouse in value, you can put those holdings to work. And I think this, again, is an important thing. Now, you started to show us by, the GOFO and the LIBOR rates and the deposit rate and all of that put together, and how you can work a position and achieve income, achieve return on something that basically is not set up like owning 100 shares of Apple. Because when Apple pays their dividends, you get a piece. or IBM or any of the other corporations. You get a piece when they present a dividend. And we say, well, gold, you put it, you got it. What do you do with it? It depends on. It is exactly correct. What do you do with it? You can do a lot with it, and you can earn income against your position. Now, one of the things that I know you're very familiar with, and I'm going to let you go there if you choose, is gold ETFs. And how can they be used to protect wealth, to build wealth, to hedge a gold position, to create a gold position? And we're going to kind of tie it up and end it right there, because I'm also watching our clock, and we're doing okay. And I think this is great information for people, and I'm hoping that they're all hanging on there. But can we talk about that a little bit?
Sure. So one way that a person can take advantage of these complex things I was just talking about, if you're a central banker, you can go, give swap a bunch of gold with a bullion bank and receive dollars and get interest and pay, get the difference and all that. The average person is not going to be able to do that, but the same concept can be done with investment vehicles available to, I want to say, the average or retail investor, whatever you want to call them. And this is not a recommendation. I'm not making a recommendation. I'm not saying everyone should run out and do this. This is educational. Amen. And it involves risk, especially if you don't do it right. But as a concept, the same way a central bank swaps its gold with a bullion bank and pays the gold full rate and then gets the difference and earns money. You mentioned the gold ETF or gold ETFs. You can do a similar thing in that respect if you have the certain option level approval from your brokerage firm, for example, and it's right for you. That's a big thing there, if it's right for you.
Yes.
A person can consider taking a look at being long the gold ETF or a gold ETF and selling calls against it. So when you sell a call against it, you're taking in that premium until it expires, and then you do it again and again. You're taking in premium. You're basically holding an ETF and you're putting it to work. You're taking an option premium. It's not exactly the same exact formula as a central bank would do, but it's the same concept, because there are hedge funds and other entities that use that type of a strategy that might even involve complex option strategies that bleed a return out of gold holdings and silver holdings.
Right.
That's one way to do it. There's also other instruments too that it's the same general concept. And I'm not saying people should do this, but you can move from a gold ETF and a stock brokerage account over to a futures account, and you have gold futures and options on futures where you can consider doing the same thing. Now, there's certain things that would happen if you sell calls against a gold ETF or a gold futures long position. If gold goes up a lot, your position is going to get called away if you don't manage the position. So if gold's at 1,800 and you sell a 1,900 call and it goes to 2,000, your position is going to go in the money and you're going to get it called away unless you manage it. And there are ways to manage it. That's the kind of thing I love to do, is manage these kind of positions. But you can manage it so that it doesn't get called away if you don't want it to, or it gets called away and you go do another trade. So anyway, these are some educational ideas on how a gold position can earn a return while you're holding on to it for the long term, possibly for the reasons I gave, and that is to defend and build your wealth, to preserve your operational wealth, to guard against the debasement of the dollar that's happening all the time, and you having to come up with more and more dollars to buy goods and services. While you're waiting for gold to go up, it might be something people can consider, and that actually people do, especially hedge funds and so forth.
Right. Now, let's bring it current. We can take a look at Friday, and which caught me by surprise, folks. I got to be honest with you, caught me by surprise what they did in gold. When I compared it to what the dollar was doing and what interest rates were doing, then it made sense to me. But the severity and the quickness of that drop caught me by surprise. So conversely, you're talking about, when you put on a position, where you are long gold. And that would be, and I'm going to reference myself because that's what I would have been. I'm long gold, but I will always attempt to hedge that position against what we saw happen on Friday, which totally came just like, wow, look, boom, gold's down. Down 10, down 15. Okay, I can live with that. Down 25, down 30, down 40, down 50. You're like, whoa, what are you guys doing? And then, as you mentioned, which is very astute and correct, it was over $100 of 2 days. So it's like we've gone from hitting 1975 on Wednesday to hitting 1862 on Friday. That's $100. That's $100, and it closed right at that $100 mark. So again, using that same thing, you're long gold, you short the call, or you buy the put. Whichever one you choose. All right, if you're selling the call, you're selling somebody else the right to buy that gold at that strike price from you. If you're buying the put, you're protecting yourself because you're going to then have the right to sell somebody that gold at that strike price. Both, if you're using it against a long position, protect you on downside.
Right. And I'm pretty big on, if you're going to put on a position that's a hedge, let's say I'm long gold and I want to buy some puts to hedge it, I'm big on funding that with something. So if you're long gold, for example, you could sell an out of the money call and use that premium to buy a put that then effectively collars your position, meaning if gold does something like it did, drops $100 an ounce in 2 days, you've received call premium to help fund the puts you bought, which are going to cost you money because it's a hedge, but you buy the puts and gold drops and you've funded your position, which doesn't seem as important. Thursday and Friday, $100 drop. Who cares if the put's funded? It's really going to pay off. But in times when gold doesn't drop like that, and your put just sits there and decays until it expires, and now you lost money hedging your gold position, selling a call to fund that can help fund the lost money in the hedge position.
Right.
Again, I'm hoping this isn't too complicated because it's not necessarily for everyone, and commodities involve risk, and so do options and all that stuff. I mean, it's really important. This is educational. I hate to keep saying that, but I don't want people to run out and start doing this.
Right. And
you have to fully understand,
maybe
even get the advice or the management of an expert.
I'm gonna back you up on that. I want people to understand neither myself or Dan are making any recommendations for any positions in gold or anything that we talk about. It is truly educational. And again, and by the true to the word, folks, what we're really attempting to do is just open the conversation, open that the concept that people have always thought for so many years, gold doesn't give you anything. I'm going to own gold. What do I get? It's like, you get a storehouse of value. What do I need that for? Well, up to this point, the last strong inflationary period that we had was way before most traders were born that are trading now. They weren't around. But I'm old enough and was there and on a trading floor, folks, at the time in 1981. And to be honest with you, during that period of time, I did own real estate. I did walk into a bank at the time and was putting on a second because I was going to go buy another piece of property. And suddenly I'm looking and down and going like, you're going to charge me 18%? And that's what really can happen in a period of inflation. Or when somebody like Paul Volcker is stepping up to the plate going like, I got to take the money out of your hands, folks. You're not going to like it, but it's the only way I can bring us down to get us ready to do what ended up being at the time, and you were there and you remember as well, 1981 to 1987. It was a straight up line, folks. It was straight up. But then we did our little crash in 87, but then from there, I remember clearly the phone call that I got from Dan in 1990 saying, it's a bull market. And sure enough, it absolutely 100% was, and it was dynamic, and it was jaw-dropping, even with the problem that we had in 1991 with the Gulf War. I mean,
Right.
if we put the picture together and we followed our Elliott, which is what we did, we were ready for that decline that we saw. But I'll tell you what surprised a lot of people was the fact that when that war did start, we were thinking, okay, fine, we're not going to drop to the basement. And we didn't. We ran to the roof.
Yeah, went straight up that morning.
That morning. Absolutely. And you were in the US. I was in Europe. So we even got it was the morning, but we even got it before, because we're all looking, going like, why is Tokyo up 1,000? Why is whatever it was?
Right.
Shouldn't they be down? And everybody's looking at each other going, well, they're not. Uh-oh. And then we started to see everybody's flowing over to their trade desk going like, I need to buy X amount of deltas. So I am going to wrap it up for today, though. So we want to try to keep these at a reasonable amount of time. There's so much to cover. And again, I want to say thank you, Dan. But I think that even Dan, as we discuss amongst ourselves, when we're talking with one another, that we are intending to try to make these a pretty regular thing, and basically eye of the storm, but also taking a look behind the curtain. And then what our goal is there to kind of just bring some understanding to what we're seeing happening in the markets, and how that does not necessarily have to be equated to a bullish or bearish stance. It may be a bullish move, it might be a bearish move under the context of what the word suggests, but the move themselves, that what we saw on Friday, really didn't have a whole lot where all of these firms were turning bullish. They weren't. It had to do with the individual positions that they had in the S&P, in Tesla, in Meta, in these different stocks. And the fact that they had a big portion of those positions were expiring on Friday. We want to go into that type of detail of looking behind the curtain to bring some clarity to what we're seeing, and how we as traders can be looking forward to understanding in the future what we might say and how you can apply that to your trading. Again, daily, maybe your swing, or whatever the situation is. We will be continuing to cover the conversation of gold, because it is ongoing. And we did see a big drop on Friday, and we could spend a whole hour just discussing why that took place and what really was happening behind that curtain, and what causes it, and how we might be able to see, again, gold turn around and go up $100. And people are like, well, why were they selling it? It's like lots of factors. But again, if we're going to get into the concept that gold doesn't like inflation, and normally what it does, it will go up. Because what's happening, folks, the dollar is inflating, right? If the Federal Reserve and other banks have got to pay more interest because they need our dollars, well, the only way I'm going to give you my dollars is you're going to give me more for you to have it. And that's really the whole concept, and that's what's happening. Now, thank you, Dan, for joining me again today. And thank you, everybody else, for hanging out with us this afternoon, this evening. And we'll be back. We will do this again. So stay tuned, and I'll get them published as soon as I can. Again, thank you. Please tell us and tell everybody once again how they can contact you.
Yes, so I'm publishing these reports out of defendingyourmoney.com. Defending Your Money was a radio show, actually, that was born in the crash of 2008 that I was giving. I've had radio and TV shows over the years. Defending Your Money, I called it. It's a great way to describe what you really need to do. So we've got defendingyourmoney.com that's been coming up. That's where I'm publishing the reports, and you can go there, or you can email us at info at defendingyourmoney.com. And for Eye on the Storm listeners here, we're offering a 33% discount off of the updated gold, Tapping the Power of Gold to Defend and Build Your Wealth report. We're publishing it this month, February 2023. So in the body of your email, if you write us, say, I heard you on the Eye of the Storm show, and we'll give you a 33% discount, or go to defendingyourmoney.com. There we get into the nitty gritty about what Michael and I have been talking about today.
Thank you again. And thank you again, folks. Have a great balance of Saturday. Have a great balance of the weekend. And we will be back next week.
Thank you, Michael. See you later.
Good night.